Hi, Jonathan York from Bay Financial Partners, looking at the investment markets. With both the budgets out of the way now in New Zealand and Australia, sort of quite interesting just to compare them. Australia was sort of quite a tight budget there, with a few cost-cutting exercises trying to get the budget back into surplus, whereas New Zealand was a little bit more relaxed and a slight loosening of the purse strings as we look like we will come back into a positive balance over the course of this year. In terms of interest rates here in New Zealand, still expecting a further rate increase here in June. Possibly puts the July hike on hold though, with the high currency persisting, and then we revert back to a rate increasing cycle back in September as the Reserve Bank looks to increase rates and just rein in this economy that really is pushing on at quite a reasonable rate. And obviously that has quite a marked impact for fixed interest portfolios. If you look beginning of the year, the OCR started at 2.5. By the end of the year it could be around 3.75. So as I said, that has a pretty major implication out there for your fixed interest portfolio, and you really do need to review that to make sure you are positioned now for these rate increases coming through. And call us on 0800 867 323 to book an appointment to get that fixed interest portfolio reviewed. Equity is still a little bit nervous out there, but on the whole they're sort of trading with a reasonably firm bid. Still a lot of nervousness in the tech sector as the Nasdaq comes under increasing pressure out there in the US. But overall earnings have been pretty encouraging for the US, and we expect say the equity market to trade just a little bit higher towards year end now. Of course, certainly in the New Zealand market there are some excellent opportunities out there, especially if you're looking for income. Some of these shares now are offering some pretty decent dividend yields, and that compares quite favourably out there with the fixed interest or the term deposits from the banks. Still quite a bit of talk out there with China as this perceived slowdown is sort of seen to be taking hold. I think you do have to remember that China is coming from quite a unique place. It was looking at sort of 12-13% growth annually, and that really needed to slow down in order to maintain this sort of growth going forward. And certainly 7-7.5%, while quite a bit off from the recent highs, is sustainable over the foreseeable future. So to summarise, I say you really need to review that fixed interest portfolio, and if you're looking for income options, I say don't be afraid to look at some of those high dividend shares out there, which really do offer some pretty attractive options. Call us on 0800 867 323 or go to the website www.bayfinancialpartners.co.nz for lots of interesting articles. We look forward to speaking to you soon.